Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. Today we are talking about 5 insights that you can get from your tax return. Now, I am joined by Mr. Michael Sellers, Jordan Shinsky. My name is Matt Landon. Michael, I believe you've got topic number 1. What have we got?
Well, basically, you want to review your return every year. Are you getting a big refund or are you owing a large amount? Ideally, you want to kind of fall right there in the middle and maybe get a little refund or owe a little bit. You don't want any of the extremes.
Well, why is that? I always thought if you get a big check come April, that's a good thing. What's the downside here?
It's a good forced savings for some people, but essentially you're giving a large interest-free loan to the government. So,
never mind. They get enough of our money already.
Yeah.
Jordan, what's number 2?
Take the time to understand the difference between your marginal tax rate and the effective tax rate. So these are 2 different things that people really have to realize. Think of it this way. If you're married filing jointly and you have $200,000 worth of income, you're going to fall within that 24% marginal tax bracket. But that doesn't mean you're paying 24% of your taxes in total from what you earn. So everything, because we have a progressive system, it ramps up 10%, 12%, 22%, 24%, and onward, that every time that you hit that income level, it bumps up. So your average or your effective tax bracket is the average of what you pay, which ends up being, in some cases, significantly lower than what your marginal rate is.
So if that break is, let's say, $80,000, anything I make up until $80,000, I'm paying one amount. Mm-hmm. If I make $83,000, am I now paying the new amount on all of it, or is it just on that $3,000?
It's only on what's over that you're paying that higher percentage on. That's why, as a progressive system, the effective rate is oftentimes much lower than what your marginal rate is.
So I heard someone say one time, I turned down a raise because I didn't want to pay more in taxes. What you're saying is that was the wrong decision to make.
That's the wrong decision.
If they offer you a raise, you take it. That's a free piece of advice for everybody here. Now, number 3 here is plan for standard versus itemized deductions. So a standard deduction is a set amount where they say, we're just going to go ahead and give you this off of your tax return. For a single individual, it's going to be a little bit over $12,000, meaning for a married couple, it's about $24,000. If you're over the age of 65, there's some added benefits there. Itemizing is where you go through and you add it all up line by line and you say, I think this is going to come out above the standard deduction. Now, something you want to think about here is bundling. If the standard deduction is set at this amount and you're a charitably inclined person and you keep bumping up to it, but you don't quite reach that line, why don't you look at doing a charitable, a qualified distribution all at one time into a charitable donor advised fund, right? Mm-hmm. So when you set up this donor advised fund, you might go ahead and make that charitable contribution of 4 or 5 years all at one time. That's going to push you far above that standard deduction. And then inside of that fund, you can disperse it to those charities over the next few years. This is money you were already planning on giving away, but you've maximized that tax benefit this year, and then you're getting more benefit from that standard deduction over the next few years. So thinking through that, as far as do I want to be standard, do I want to be itemized, how's it best going to impact me, that's something you can kind of take on a strategical standpoint. Now, what's number 4?
The other, thanks, Matt. The other one is similar in that mindset of consider gifting appreciated shares or appreciated stock. So if you've worked for a company for a long time and have lots and lots of shares of it that were purchased 30 years ago, that's a great source of funds to gift to charities and get the deduction.
So what you're saying is I don't get hit with all those capital gains.
Right.
I bought it for $3,000. Now it's worth $30,000. You can gift those shares into a fund, and it doesn't have to be all of them.
Right.
And then you're not paying taxes. In fact, you're getting a tax break.
Right. It's saving you from having to pay a capital gains on all those shares when, in fact, you're only, object to do was to gift to the charity.
See, that's what I call killing two birds with one stone.
Yeah.
If I can give more to charity and less to Uncle Sam, that feels like a win-win. I like that a lot. Well, will Jordan close us out? What's number 5?
So the last one isn't just limited to taking a look at your tax return. This is something you should be doing on an annual basis anyway, but it's revisiting your contributions to your retirement savings plans. So understanding, I'm putting 6% to my 401k, or I'm contributing to a traditional or a Roth IRA every year. This is something you need to be able to look at and say, should I make an adjustment? Am I on track for my long-term savings or my retirement strategy? And then based on, in relation to your tax return, can I make more without putting myself into another bracket, or what adjustments can I make to optimize my tax return?
Can I parlay off of that for one moment? Don't just think about this coming tax return. Think about your tax returns into the future. Mm-hmm. If you put all into a Roth instead of traditional, you may pay a little bit more today, but it might save you a lot in the future. So I think that's where sitting down with a professional can be a lot of a benefit for you. I think looking at that tax return on a regular basis, there's a lot of value there. I hope these five things are areas that you can look at, you can explore. Tax time, it's not always fun, but let's make the most of it the best we can. That said, on behalf of Jordan and Michael, I'm Matt. Thanks for watching. We look forward to seeing you next time.